Welcome to The Deep Dive. We're here to help you quickly make sense of complex stuff. Today, we are digging into the transcript from the Fed's press conference, September 17th, 2025, the FOMC meeting.
Yeah, and this one, it really threw people for a loop. You had the FOMC cutting the federal funds rate target just a quarter point down to that 4 to 4.25% range.
Right, which usually signals, easing up.
Exactly. But then in the same breath, they're saying inflation is still somewhat elevated.
And that's the puzzle, isn't it? Cutting rates while inflation is still, well, sticky. It feels like they're calling victory maybe a bit early.
We're trying to get ahead of something else.
So our mission today,
Yeah.
figure out what specific data points made the committee suddenly worry more about jobs than about that stubborn inflation. Why this pivot now?
It really comes down to one phrase the chair kept using, a shift in the balance of risks. That's the code we need to crack.
Okay, so let's start with the framework. The Fed has that dual mandate, right? Keep employment high, keep prices stable.
Correct. And for what, almost 2 years now, the laser focus has been on prices, slamming the brakes, basically.
Tightening policy to fight inflation.
But this meeting signals a change. They're not just looking at inflation risk anymore. The chair explicitly said it. Risks were tilted toward inflation, but now, downside risks to employment having increased, that flips the balance.
Okay, flips the balance. So they move towards, what do they call it? Neutral.
A more neutral policy stance, yeah. Taking a
Right.
step back from actively restrictive policy.
But hang on, if they're really worried about jobs, why just a quarter point? Why not 50 basis points to give the economy a proper jolt?
Good question. And that's because they framed this specifically as a risk management cut.
Risk management, meaning,
Meaning it's not really about stimulating growth right now. It's tactical, it's insurance.
Yeah.
Look at their own forecasts, the SEPI, the Summary of Economic Projections.
right.
They didn't really slash their GDP growth outlook. Still predicting, 1.6% this year, 1.8% next. Unemployment forecasts were pretty stable too.
So the SEP, their medium-term view, didn't scream recession. This cut wasn't about heading off a downturn they see coming months from now.
Seems not. It was about managing a risk they see right now in the labor market data.
Okay. And the fact that not everyone wanted a bigger cut, that tells you something too.
It does. It shows this is cautious, a fine-tuning, not some dramatic U-turn. They also said they'll keep shrinking the balance sheet. That's another sign they haven't totally given up on inflation watch.
So still trying to fight inflation, but now also trying to cushion employment.
Yeah, the chair even said something like, policy's been doing the right thing so far this year. Like, we're adjusting, not abandoning the plan.
All right, let's get into that labor market problem then. The chair said it's really cooling off. What's the actual evidence?
The payroll numbers are pretty stark. Job gains have slowed way down. Over the last 3 months, the average was just 29,000 per month.
29,000. That's barely anything, isn't it, considering population growth and everything?
Exactly. It's running below what they call the break-even rate.
The rate needed just to keep unemployment flat.
Yeah. If you're creating fewer jobs than people entering the workforce, unemployment is going to tick up. And guess what? It did. Edged up to 4.3% in August.
Okay, 4.3%. Still historically low, but the direction is what worries them.
Precisely. It's the trend.
So what's causing this cooling? Is it just high interest rates finally biting, killing demand for workers, or something else?
It's tricky. The chair called it a curious balance. It seems to be both things happening at once. Worker supply is lower. That's partly lower immigration, maybe lower participation too.
Okay, supply side issues.
But the trigger for this rate cut seems to be a sharper drop in labor demand. Employers are pulling back on hiring. Someone asked about tariffs hitting jobs, but the chair pointed mainly to immigration changes as the big factor slowing worker supply. Demand is a separate, more recent worry.
And this situation, this specific kind of cooling, it creates a particular problem for people looking for work, right? Especially, certain groups.
Absolutely. It's what some call a low firing, low hiring environment. Layoffs aren't spiking yet, which is good. People aren't losing jobs in droves.
Okay, that's a relief.
But, and this is the crucial bit, the hiring rate is way down. The job finding rate is very, very low, according to the chair.
So if you do lose your job,
Yeah.
good luck finding another one quickly.
Exactly. The doors just aren't opening as often. And the transcript specifically mentioned this hits vulnerable groups hardest. Younger people, like new college grads trying to get started, minorities too.
What was the number for black unemployment?
Over 7% in August. So you see these disparities widening in this kind of environment.
And the underlying fear is what? that if layoffs do start picking up, even a little,
Hmm.
then because hiring is so weak, those people could struggle for a long time. Unemployment could shoot up really fast.
Yeah.
It's like the system has lost its ability to quickly reabsorb workers. That makes the employment risk feel much more immediate. Okay, that paints a clearer picture of the employment side. But let's not forget the other mandate, stable prices. Inflation is still the elephant in the room, making this cut feel awkward.
Definitely awkward. Inflation is still too high. Let's look at the Fed's preferred measure, PCE, personal consumption expenditures. For the 12 months ending in August, total PCE prices were up 2.7%.
Still quite a bit above their 2% target. And what about core PCE, stripping out food and energy?
Core PCE was up 2.9%, almost 3%.
See, that's the sticking point, nearly 3% core inflation. Cutting rates into that seems, well, risky on the inflation front.
It shows the inflation isn't just about gas or groceries anymore, it's broader.
And didn't the transcript mention something surprising about goods prices? I thought goods inflation was supposed to be dead.
Yeah, that was interesting. Goods inflation actually picked up a bit recently. It's running at 1.2% over the year now. Meanwhile, services disinflation seems to be continuing, but goods are adding a little pressure back.
Any idea why?
The main suspect mentioned was tariffs. The analysis suggests tariffs have started feeding through to prices more noticeably, possibly accounting for, most or maybe even all of the uptick in inflation this year.
So tariffs are pushing up goods prices. How does the Fed think that plays out? Is it temporary?
Their base case, what they hope for, is that it's a one-time shift in the price level, something relatively short-lived.
A blip, basically.
Yeah. But the risk is that it's not just a blip, that it becomes more persistent, maybe affects inflation expectations or wages.
And is it hitting consumers directly yet?
Apparently, the pass-through has been kind of slow. Companies in the middle, like importers or distributors, seem to be eating some of the cost for now.
Absorbing the hit to protect market share, maybe?
Could be. But the transcript suggested they do intend to pass those costs on eventually, so there might be more inflation pressure still in the pipeline from tariffs.
More uncertainty baked in. And speaking of uncertainty, AI came up too, didn't it? How does that fit into this puzzle?
It adds another layer, particularly to the labor market side. It wasn't the main driver of the decision, but it's this background factor. Could AI be contributing to that lower labor demand? Especially for, say, entry-level jobs that younger people might take.
So technological change, potentially reducing the need for workers, compounding the low hiring problem.
It's a possibility they have to consider. It just makes forecasting maximum employment even harder than usual if the very structure of work is changing under our feet.
Then past experience isn't a great guide. Yeah.
Okay.
Makes sense why they'd focus on managing near-term risks.
Exactly.
So let's look at their own roadmap, the SAP forecasts. Where do they actually see rates and inflation going?
Okay. The median projection. They see the Fed funds rate around 3.6% by the end of next year, 2025, then drifting down to about 3.1% by late 2027.
So more cuts expected over the next couple of years. What about inflation? Where does that 3% core PCE go in their forecast?
Well, total PCE inflation is projected at 3.0% for this year.
3% this year. And when do they see it getting back to their 2% target? This is the big one for credibility, right?
It is. And the median projection doesn't actually show inflation getting back to 2% until
2028. So they're forecasting another, 3 full years of missing their target?
Yeah. That's what the median projection implies.
How do they explain that? Setting a target and then basically saying, we don't think we'll hit it for years.
The chair framed it as, this is the path they currently think is needed to eventually get back to 2%. It's not a promise, more like a statement of intent given the difficult trade-offs. They stress policy isn't on a preset course. They'll adjust based on the data meeting by meeting.
Which you can definitely see in the dot plot, right? The chart showing where all the different committee members think rates should go.
Oh, absolutely. The spread in those dots, the dispersion of views is pretty wide. Unusual, the chair called it, but also natural.
Natural because?
Because there's no risk-free path right now. When your two main goals, jobs and inflation, are pulling in opposite directions, it's genuinely hard to know the perfect path. Reasonable people can disagree.
Even when the data itself is maybe not perfect. Did they talk about data quality?
They did. They acknowledged the data can be noisy. Things like preliminary payroll numbers getting revised, low response rates on surveys.
Yeah, we hear about that a lot.
But they basically said, look, it's imperfect, but it's well good enough to do our job. They have to work with what they have.
And quickly, there was also a question about political independence, wasn't there? Because of a new committee member with ties to the White House?
Yes. The chair gave the standard but important answer, said the Fed's DNA is to base decisions purely on the data, the economic outlook, and the mandate, not politics.
Okay. So let's try to wrap this up. What's the bottom line here? Why did they cut rates in September 2025?
The main takeaway seems to be they acted not because the whole economy is collapsing, GDP is okay, unemployment is still low overall. They acted because the risks to the job market, specifically that low firing, low hiring dynamic and what it could lead to, became too real to ignore. It shifted from a potential risk to a reality, as the chair put it.
So an insurance cut against a possible sharp downturn in employment, even while inflation remains a problem.
Exactly. It's damage control preemptively. And it highlights just how complex things are right now. Lower rates might help housing a bit, support activity, but they're juggling persistent inflation against this weird labor market slowdown driven by things like immigration policy and maybe even AI starting to bite. It's uncharted territory.
Which leaves us with a final thought for you, the listener. The Fed cut rates because job risks became real, even with core inflation near 3%. Their own forecast doesn't see 2% inflation until 2028. Given they admit forecasting is incredibly hard right now and no one has great confidence in projections.
Yeah.
What does that 2028 target really tell us about how much weight the stable prices gold truly carries today compared to protecting jobs? Something to think about. Thanks for diving deep with us.